This segment is brought to you by Equity Management Academy. Hello, everybody. This is Patrick Montes-Dioca with Trading Talk. We have the honor and pleasure to have with us today Dr. Marc Faber. Dr. Faber publishes a widely read monthly investment newsletter, the Gloom, Boom, and Doom Report, which highlights unusual investment opportunities, and is the author of several books, including Tomorrow's Gold, Asia's Age of Discovery, which was first published in 2002, and highlights future investment opportunities around the world. Since 1973, he has lived in Hong Kong. From 1978 to February of 1990, he was the managing director of Drexel Burnham Lambert. In June 1990, he set up his own business, Marc Faber Limited, which acts as an investment advisor and fund manager. Welcome to Trading Talk, Dr. Faber.
Yes, thank you very much.
In a recent report, Sprott Group pointed out that the vaults are booming in Asia. Can you give us your insight as to why there is so much gold potentially headed towards Asia and China's record demand for the yellow metal?
First of all, in Asia, it has always been a tradition to own gold, particularly in countries like Hong Kong, Singapore, Indonesia, Malaysia, Thailand, and of course India. And in recent years, China has opened up, and whereas gold was illegal, it was illegal to own gold in China until about, I think, 10 years ago or so. Now the government is actually encouraging people to own gold. So the demand has been very strong, also because there has been a huge increase in the number of well-to-do people and in the wealth of Asia. And so from that side, the demand is rising very rapidly. And I'd like to also point out that China is basically likely to have eventually a world currency, and I think they may wish to back that currency with gold.
Do you expect these record levels of demand to continue in the future?
Yes. I think it will rather increase than decrease, whereby, as you know, in India, they made it very difficult and expensive for people to buy gold. But, of course, it will encourage smuggling, so the demand will continue. It's not going to go away. And in the case of China, I think that eventually, if the economy slows down, the government may do what other central banks have done everywhere in the world, namely that is to print money and weaken the currency. And so I would expect that, especially if there was an economic problem or a crash in the Chinese economy, that the gold demand from China would actually increase and not decrease.
And what is the driving force in this transformation of the ownership of gold from the west to the east, and in China in particular, even though you've addressed some of these issues?
Well, we have to realize that over the last 15 years or so, we had a shift in the balance of economic power from the old world, which is Western Europe and the US and to some extent Japan, to emerging economies. Most of the growth in the global economy over the last, say, 10 years has come from emerging economies, notably from China. And so there has been this shift in the balance of economic strength to the east, and with it, there has been a transfer of wealth from the west to the east. And with it, obviously, the demand for gold has shifted to the east, keeping in mind that essentially central banks still own roughly 21% of all the gold in the world. But most of it is in the hands of Western central banks, if they still have it. That's a big question, which Eric Frost has raised on numerous occasions. But say, in Asia, we have central banks that have very large foreign exchange reserves. In the case of China, more than $3 trillion, but they have maybe 2 to 3% of their money in gold. So they can increase it significantly over time, and I think that is the pattern that will happen also in other emerging economies, including Russia and Kazakhstan, the other Central Asian republics, the Middle East, and so forth.
Let's move into the mining sector for a minute, Dr. Faber. Is the mining sector a buy, hold, or a sell strategy?
Well, I mean, I'm always amazed that when you talk to investors, everybody agrees that you should buy low and sell high. But when it comes to actually investors' behavior, they buy high and sell low. In other words, the most popular stocks in year 1999-2000 were the overpriced Nasdaq stocks. And today they made a lot of noise because the Nasdaq went over 4,000 when in March 2000 it was at 5,100. So in other words, 13 years later you're still below the peak. Mm-hmm. And more recently the most popular stocks were companies like Twitter, Yelp, Tesla, LinkedIn, Salesforce, Facebook, and these were the high-flying stocks. But now, all of them are down 20% from their recent highs or more. Tesla is down 35%. So people, they buy things that are moving, and usually they're moving closer to a top, and they don't want to buy what is inexpensive. And if I look at all the assets in the world, fine wines, real estate, stocks, bonds, commodities, and so forth, I have to say that gold and silver are relatively inexpensive, and gold and mining shares in general is the only sector in the market that is very cheap.
Are we experiencing the destruction of gold demand in the West, or is this significant indication of the shift in power from West to East, or the end of the U.S. dollar as the world's reserve currency?
Well, I think the dollar will stay as a reserve currency not because there's anything particularly good about the U.S. dollar, whereby I have to say that the energy dependence of the U.S. on foreign producers has been diminishing, so that's a plus. But there are many other negatives, including Obamacare and the lack of education and so forth and so on, and the dysfunctional government. But in general, from a currency point of view, actually the dollar should have been stronger. The problem is the other countries and the other currencies are no better. So, in my view, well-to-do people and people that are thinking for themselves, they will over time continue to diversify out of paper money into physical gold.
How can a major correction in the U.S. stock market affect the rest of the world stock markets?
Well, I'm not saying that every market trades around the S&P, but most markets are quite closely correlated to the S&P. In other words, if the S&P tonight closes up 15 points, it is likely that in Asia, most markets will be up tomorrow. And if the S&P closes down 15 points, it is likely that most Asian markets will be down tomorrow. Similarly, the European markets will kind of follow the S&P. So the impact of the U.S. on the global economy, on the global financial market is, of course, very large, both in terms of interest rates and in terms of equity price movements.
Do you see a significant correction in U.S. stocks on the horizon, or just a minor correction in the long-term bull market?
Well, I've been arguing now for almost a year that we might have a 20% correction in the market, but I always explained that it is also possible that we are in a market like in 86, 87, when the market just kept on going up and up and up, and eventually we had a huge 40% crash within 2 months. And that scenario, in my opinion, is now increasingly likely sometimes in the next 6 to 9 months that we may continue to go up. We don't know when the end is here, but as I mentioned, some of these high-flying stocks that were leading the market, they're no longer participating. At the same time, we have established technology companies like Intel, Cisco, lower today than in 2010, IBM lower than in 2011. But at the same time, we had strength in oil shares and in kind of very, very high-quality companies such as Procter & Gamble, Johnson & Johnson, Walmart, that may still support the market. But if you ask me, I think the technical picture of the market doesn't look particularly good. So all I'm saying is we bottomed out March 6, 2009. In 6 months' time, on March 6, 2014, the bull market will be essentially 5 years old. This is longer than most bull markets have ever been. We went up from the low, S&P 666 to over 1,800. We're up almost 3 times. So if someone tells me we're at the beginning of a bull market, that's nonsense. We are somewhere near the end of a bull market, and I don't think it's a particularly good time to increase equity positions. I think it's probably a good time to reduce them.
To move back into the metals markets once again, is the gold and silver ratio telling us anything about the value of silver?
Well, some experts may tell you that, yes, it has a meaning and so forth. I don't think that the meaning is all that relevant. And I'm constantly asked by people whether I like silver or gold or which one they should own. All the precious metals will basically move in concert. In other words, if gold goes up, silver will go up.
Sure.
Now, will silver go up more or less than gold? Who knows? There are times when silver has risen more than gold. There were also times when silver has declined more than gold because it's a more speculative precious metal. I think if someone wanted to have a basket of precious metals, I would look essentially at owning both gold and silver, and probably I would also look at platinum because there the demand-supply situation is rather favorable.
Do you prefer to own gold or stocks as a long-term investment?
Well, I prefer to own physical gold and to store it outside the United States. That is an important issue to consider. Where do I store my gold? And because I'm on the board of some gold and silver mining companies, resource companies, including Sprott Inc., I own shares in mining-related equities and also in mining companies such as Ivanhoe Mines, Nova Gold, Sunshine Mining, and so forth. So I have an exposure to both. But if you ask me my personal preference, I prefer to own physical gold because I think that the entire financial system is going to implode at some point in future.
Let's shift gears for a minute here. And what are your comments on the U.S. monetary policy with regard to QE or quantitative easing? Or are we going to see tapering from the current $85 billion monthly bond purchases by the U.S. government?
Well, basically, I've been arguing for a long time that the U.S. monetary policies are a disaster because you cannot deliberately create bubbles in order to boost sustainable economic growth. You can create a bubble that creates an artificial boom, so-called crack-up boom. But that is then followed by a collapse like NASDAQ after 2000, or the housing bubble, the credit bubble that led to the housing bubble, that then collapsed in 2007 and 2008 and so forth. And then the damage on the economy is far greater than the earlier benefits. And that the Fed never realized. Now, the Fed and their media friends and the academics, of course, they will all come forward and say, oh, Mr. Bernanke saves the world in 2008, 2009, when in fact Greenspan and Bernanke almost destroyed the world. That is not mentioned properly in the media, and that is the fact. And we had artificially low interest rates post-2001, when the Fed fund rate dropped, was lower to 1% until June 2004. And we are now in the fourth year of an economic recovery, and as I mentioned to you earlier, almost at the fifth year anniversary of the bull market, and we still have a Fed fund rate around 0%. It will lead to a colossal misallocation of capital. It punishes savers that have saved all their lives for retirement. They have some money in the bank. They get no interest on that money anymore. So they're forced to essentially speculate, and it will end very, very badly. But will it end very, very badly tomorrow or in 3 years from a higher level? Who knows? I've seen money printing exercises that lasted a very long time until they finally came to an end in a catastrophe.
Is the U.S. economy strong enough to require such a change in monetary policy yet?
Well, I mean, basically, we had since November 2008, when QE was introduced the first time. At that time, they were talking about an exit strategy. You will never hear any exit strategy nowadays. They talk about maybe tapering. When they started QE1 in November 2008, my argument was, believe me, we're going to go to QE 99. We're never going to stop the programs, because when governments introduce new programs under the excuse of urgency or to fix something, usually these programs stay in place for a very long time. And this whole talk about tapering, yeah, maybe they'll do kind of a cosmetic tapering at some point by actually, I have to say, as of today, this year alone, the Fed has bought more than $1 trillion worth of treasuries and mortgage-backed securities, because they not only have this $85 billion of asset purchase program, but they also have the accruing interest to invest. So actually they bought much more than is kind of made public. Now, can they go down from a purchase of, say, 85 billion to 65 billion? Yes, it's going to be cosmetic. As soon as the economy weakens again, as soon as there is any crisis, they'll go to $150 billion a month or more.
What is your point of view on the U.S. dollar and gold if interest rates begin to rise? And how would this affect the world economies?
Well, I think it's quite likely that interest rates will go up. But we have to understand in what context. At the present time, we have a zero Fed fund rate. Now, please explain to me and your listeners, what do you think are your cost of living increases annually in the U.S.? 1%, 2%, or more likely more than 5%, including insurance premiums, including food, including energy, including health care. What is it? In my view, for most American families, the cost of living increases are between 5 and 10% per annum. So we have a zero Fed fund rate, so in real terms, inflation adjusted, the Fed fund rate is negative in the order of 5% or more. And if they increase one day the Fed fund rate somewhat, maybe to say 2% or 3%, but that would be a huge increase already. By then, maybe the cost of living increases will be in the order of 10% or 15%. So I think under Yellen and the other Fed governors that are all doves, basically, with very few exceptions, the Fed fund rate will stay negative in real terms, inflation adjusted. That is positive for gold in the long run.
Anything else you would like to add, Dr. Faber?
No, I think I made my point.
On behalf of our audience, I want to thank you sincerely for this precious time that we have spent with you. And can you give us some information in terms of how our clients can get in contact with you directly if they wanted to?
They can go to the website www.gloomboomdoom.com, all in one word. And the final comment I'd like to make is I truly believe that the central bankers are going to bankrupt the world. It may take a while, but they are well on the way to do it.
Dr. Marc Faber, publisher of the Gloom, Boom, and Doom Report. Thank you once again for this precious time, and until next time, my friend, you take care and be well.
Bye-bye. Thank you very much.